Hello everyone, I am Bhavna Sharma, Assistant Professor, Department of Commerce, Gemtech, Greater Noida. In Management Accounting, today we are going to discuss about marginal costing. Marginal costing is the ascertainment of marginal cost and of the effect on profit of changes in volume or type of output by differentiating between fixed cost and variable cost. So basically, in management marginal costing, costs are classified into fixed and variable, and with such a division, so many managerial decisions are taken. Now, the main feature is that division of total cost into fixed and variable, without which this could not have existed. Variable cost vary with volume of production or output, whereas fixed cost remains unchanged irrespective of changes in the volume of output. So basically, marginal costing is the variable cost, not the fixed cost. So a unit variable cost remains same at different levels of output, and total variable cost changes in direct proportion with the number of units. Or the total fixed cost remains the same irrespective of the change in units, while there is inverse relationship between fixed cost per unit and number of units. So talking about features of marginal costing, appropriate and accurate division of total cost into fixed and variable cost by picking out variable portion of semi-variable cost also. So valuation of stock is valued at variable cost only, because in marginal costing only variable cost is considered, not the fixed cost. So valuation of say finished goods or work in progress, so it is valued at only variable cost, not at total cost. And fixed costs are written off soon after they are incurred because they do not find any place in the product cost. Prices are based on marginal cost and marginal contribution. Marginal cost means variable cost, and it combines the techniques of cost reporting and cost recording. Now next topic is absorption costing. Now in this, cost of product is determined after considering the total cost. So this technique is also called total costing or traditional costing. Here variable costs are directly charged to the products, while fixed costs are apportioned over different products on suitable basis manufactured during a period. So under this, all costs are identified with the manufactured products. Talking about advantages of marginal costing. Marginal costing is simple to operate than absorption costing because it does not involve the problems of overhead apportionment and recovery. It is easier to make decisions on the basis of marginal cost because it shows the products are making a contribution and which are failing to cover their variable cost. Marginal costing is essentially useful to management as a technique in cost analysis. It enables the presentation of data in a manner useful to different levels of management for the purpose of controlling cost. So, marginal costing is an important technique in cost control. Future profit planning of the business can be carried out by marginal costing. Contribution ratio, marginal cost ratios, they are very useful to ascertain the changes in selling price or changes in variable cost. So marginal costing is helpful in profit planning. And last, marginal costing is helpful in forecasting also. Next, we'll discuss about the limitations of marginal costing. Separation of cost into fixed and variable. It presents technical difficulties. No variable cost is completely variable, or No fixed cost is completely fixed. So sometimes it is difficult to classify a particular cost into fixed and variable. So if we are not able to classify, then we are not able to identify or calculate the marginal cost. Next is exclusion of fixed overheads from inventories affects profit and loss account and produces unrealistic and conservative balance sheet unless adjustments are made in the final accounts at the end of the period. Next, though for short-term assessment of profitability, marginal cost is useful, but for long-term profit is correctly determined on full cost basis only. So we can say that marginal costing is helpful in determining short-term profit, not the long-term profit. With increased automation and technological developments, impact on fixed cost on products is much more than that of variable cost. A system or an organization which ignores the fixed cost is less effective because a major portion of cost is not taken care of. So fixed cost like rent or salaries of the employees, these are the major part of the cost. So if we are ignoring it, then the major portion of cost is being ignored. Next is marginal costing does not provide any standard for evaluation of performance. System of budgetary control, standard costing, they provides more effective control than the marginal costing. Next topic is differential cost. Differential cost is the change in cost which results from adoption of alternative course of action. Now, alternative actions may arise due to various reasons, like change in sales volume, change in price, change in product mix, change in methods of production, change in sales. So, differential cost is that cost in which only cost and income differences between alternative course of action are taken into consideration. So, differential means the difference is only considered, the change is only considered. Now we'll talk about what is the similarity in differential cost and marginal cost. Now both the techniques of cost analysis, both made use of management in decision making, both helps in formulating policies. The concepts of differential cost and marginal cost mainly arise out of difference in behavior of fixed and variable cost. Differential cost compare favorably with economists' definition of marginal cost. That marginal cost is the amount which at any given volume of output is changed if output is increased or decreased by 1 unit. Differential cost analysis can be made in case of both absorption costing as well as marginal costing, while marginal costing excludes the entire fixed cost. Some of fixed costs may be taken into account as being relevant for the purpose of differential cost analysis. Marginal cost may be embodied in accounting system, whereas differential costs are worked out separately as analysis statements. In marginal costing, contribution, margin of contribution, contribution ratio, these are the main yardsticks for performance evaluation and for decision making. In differential cost analysis, differential costs are compared with the incremental revenues or decremental revenues. Now, marginal cost means amount at any given level of output by which aggregate costs are changed if volume of output is increased or decreased by 1 unit. So, marginal costing is a technique. Marginal cost is the amount. If there is change in the cost due to change in the output, if the output is increased or decreased by 1 unit. So marginal cost, as I've already discussed, is the variable cost. So variable cost means direct labor, direct material, direct expenses, or any variable overheads. Or if we have total cost, if we deduct the fixed cost from total cost, we get the variable cost. Now next concept is contribution. Contribution is the reward for efforts of owner of a business concern. So contribution is the reward basically. It is not exactly the profit, because when we deduct variable cost from sales, what we get is contribution. Then, or you can calculate by adding fixed cost with the profit. So sales minus variable cost is contribution. Sales minus total cost is the profit. Now, taking an example that a product selling price is given as 100 rupees per unit and variable cost of that product is 50 rupees per unit. We have to calculate contribution. Now, contribution can be calculated in per unit or in the total amount. So, in the question, because per unit value is given, so we'll calculate the contribution per unit only. So, the formula to calculate contribution is sales minus variable cost. So, here instead of sales, selling price is given per unit. So, we'll take selling price as 100 rupees, variable cost 50 rupees. So, what we get contribution is of 50 rupees. So, if we are given sales, suppose the number of units are given 100 units. So, we can multiply per unit with 100 units. So, in selling price 100 into 100 and for variable cost 50 into 100. So, we get 5,000 rupees as the contribution. So, this is the simple formula to calculate the contribution. Thank you. In this lecture, we have discussed about the marginal costing, the basic introduction, and few concepts of marginal costing. We'll discuss further concepts of marginal costing in the next lecture.